This is Rob Rowan with CFA Society New York. Welcome to our podcast, Compound Insights. I am very pleased that Jody Gunsberg of Greystone Consulting is here to speak with us today because many of you are laser focused on how asset owners are handling the recent volatility and what they plan to do next. Jody is Managing Director and Chief Investment Strategist at Greystone, which some of you will know as part of Morgan Stanley. Previously, she was at S&P Dow Jones Indices. She is also one of CFA New York's most energetic volunteers and writes curriculum for CFA Institute. So let's dig into this. Jody, would you start by comparing this downturn to others? And I would just like to remind everyone that this recording is being done on April 2nd to put this in perspective.
Thanks, Rob. I'll keep this short since it is a very well-covered topic. But simply put, this drop is unique not only for its catalysts, the coronavirus and oil conflict, but for its speed. We've had 12 other bear markets according to our calculations, and on average, the loss was 36%, which this time we came close to with the S&P 500 down just over 33% peak to trough. But it rebounded a bit, so is down around 26% now. The worst drop happened in the 1937 bear market, losing 60%, and the global financial crisis took the market down 56.8%. So again, the drop we are experiencing thus far is fast, but not necessarily enormous. However, the volatility has spiked the most since 1987.
Yes, the volatility has been phenomenal. I have never seen it in my career. Should there be a case for people moving into simply less risky assets now?
Yeah, there are really two clear ways to reduce portfolio volatility. So the first is to mix less risky assets from equities, and the second way is to mix assets with low correlation to stocks. Some assets that generally have similar risk to stocks can still take down the portfolio risk if they are uncorrelated or have negative correlation. So while the first method of adding assets with lower volatility to stocks is usually reliable and consistent through time, the second method of relying on uncorrelated assets becomes unstable if correlations rise. So it takes careful monitoring to manage that risk.
Do you see high yield bonds and oil as a portion of that?
There are some reasonably priced assets now from this drop. Not only have stocks come down, but the ICE B of A U.S. high yield option adjusted spread is the highest since 2009, and oil is back to levels not seen since 2001. That said, there are some fundamental reasons these assets have fallen, so using them for portfolio diversification requires care. First, watching correlations matters because now these assets are highly correlated with equities and the risk reduction is less potent. But second, active management is required to select the higher quality of high yield, and in oil or commodities, contract selection to reduce the contango or storage costs is imperative.
Right. Okay. Those are complicated issues within the active management. Let's go up a level to asset allocation now. Do you think that this is an important time to think about rebalancing?
Rebalancing doesn't need to be about timing per se, but should be systematic. For example, either a periodic rebalance, like quarterly or once or twice per year, may be implemented, or a rebalance back to target weights based on a threshold can be used. So, for example, if a target portfolio weight is 70% stocks and 30% bonds, and there's a 5% buffer in place until a rebalance is triggered, then the stock market drops about 20%. We'll call it, and if bonds stayed the same with that stock market drop, then the portfolio would probably get to about 65% stocks, 35% bonds, so should be rebalanced back to the 70-30. But it is important to rebalance based on the portfolio moves rather than the asset moves taken alone. So you don't want to be buying more stocks if everything else dropped as much as the stocks did and the whole portfolio target didn't move much off of its strategic weights.
Mm-hmm. Well, that is interesting. And I love hearing people kind of go back to basics with this. Stick to the plan, stick to the asset allocation. That is just a wonderful thing and great to hear at a time like this when people are scared. So is there a reason for investors to just across the board choose less risky assets to manage the volatility?
No, I think that overall, the institutions, besides sticking to their plans, they should be rethinking their spending rates or actuarial rates or contribution rates and making sure that enough liquidity is available to meet the cash needs through this time. I think as far as asset allocation goes, if we do enter a prolonged period of very low or negative interest rates, institutions may need to reconsider asset allocation more towards risk-based allocations, and also the use of income-producing alternatives from everything from high dividend-paying stocks to hedge fund strategies might be necessary, as well as expanding the opportunity set to the global market rather than such a high domestic focus for a lot of these plans.
Okay. Well, a lot of institutional investors are sort of all hands on deck right now. Do you think that this is a good time for them to think about some of the other structures they put around their portfolio, including their investment policy statements?
I think that as far as the investment policy statement goes, it's really important to monitor them all the time and review them periodically. So if there needs to be a change in the objectives, the investment strategy can adjust to meet the new goals, but it is super important to bring back the focus onto the policy that was agreed on and only go back to that process and work with the boards and the plans in order to adjust the entire goals if that's needed, much more so than just changing a strategy on a dime based on market movements.
Mm-hmm. So outside of, let's say, an annual review of an IPS, are there other times that you would recommend it? Say changes in spending policies necessary, et cetera? Is that what you mean by that?
I think that if there's any time that a board or their consultant is getting concerned that it warrants a meeting and communication is important. We're always monitoring the portfolios to make sure that they're within the IPS guidelines, but there's always is a good time for communication. It doesn't necessarily have to be on a quarter or a year. So even if it's technically reviewed annually, it doesn't mean that it can't be reviewed more frequently.
Okay. And, if we were having this podcast, let's say 8 weeks ago, one of the questions I undoubtedly would have asked you about was ESG and how ESG policies work in. So maybe I'll ask you about ESG. Do you think that they are going to come out again as important, or have they faded into the background with this market volatility?
Yeah, I might argue that ESG has taken even more of a spotlight in this crisis. Not only has the industry shutdown seemed to have cleared some of the smoggy skies, but risk management rises to the top of concern in investment programs through most major crises. And before 2008, ESG performance largely lagged traditional counterparts. But after 2008, again, when investors got really serious about risk management, performance converged. So we saw the actions of those companies paying off. And so now there's, I think, a new focus on testing how ESG is holding up through the crisis. And not only is the performance good, but it's significantly outperforming the sin stocks. And I think, a new focus on ESG factors and what it means to be ESG might emerge around things like disaster preparedness, continuity planning, and even employee treatment through benefits like sick leave and working from home that we're experiencing with the coronavirus.
That is interesting. I didn't think about that. Well, Jody, I want to not take too much of your time, but say thank you for being here.
Thank you.
I hope all of you have enjoyed this episode of Compound Insights. You can subscribe to this podcast on the app of your choice and hear podcast details on our website at cfany.org. Until next time, I'm Rob Rowan.